Euro dollar right now is trading at approximately $1.49 or 1.4900. My prediction, which differs from some people's predictions right now, is that the euro will actually fall by the end of the year, maybe to $1.35, maybe to $1.40. So my answer is no. I don't think the euro can actually sustain the levels that it's been at currently. That's based on statistical research, but also the fundamental picture behind that trade would be simply the fact that right now the world economy is still weak. There's not really that much of a difference now in the world economy than there was even 12 months ago. There are several indications that there could be a second round of job losses in the United States, or bank failures or bank problems in the United States, bank write-downs or bank losses in the European region as well. Any time that the world economy seems to panic within the last 24 months of time, it seems that the US dollar strengthens, that investors become panicked and pull their money out of foreign assets or money that's placed in Europe or in Asia or in South America even, and pull that money back into US dollar denominated assets, particularly US government bonds, which, because they're purchased with dollars, increases the demands for dollars. Which is strange to think that an economic crisis that began in the United States could actually cause appreciation in the US dollar. It does make sense if you think about for a moment that money will be flowing out of assets that are foreign to the United States, coming back into the United States. So they'll be selling euros, selling European stocks, selling Asian stocks, selling Asian currencies, and buying US dollars to keep them protected, keep them in bonds, and maybe accept a lower rate of return in exchange for greater safety. So with that demand for the US dollar going into the next year, I think we might see the euro fall maybe 15 cents or 1,000 pips. Major driver of currency exchange rates today is simply the world economy, simply sentiment about how the world economy is doing. And it's measured in just a few very simple statistics. One, oil. Oil is incredibly important as the most important commodity that I think we look at today. China starts its own commodities market or commodities exchange, and oil prices seem to be stabilizing a little bit. When oil prices move from current prices now, one way or the other, it will dramatically affect not just the Canadian dollar, but it will dramatically affect other currencies that are economies that use a lot of oil. The US economy, the European economy, and in particular, the Asian economies will be affected enormously by the price of oil. That's driving prices now. The US equities market is a major barometer or measure of sentiment in the currency market today. So for instance, if the Dow Jones Industrial Average is able to stay above 10,000, which it's not there yet, but if it reaches and stays above 10,000, that's bullish for the euro, that's bullish for the British pound, that's bullish for the Japanese yen. However, if we see continued job losses in the United States, that would be bullish for the United States dollar, and that could cause significant appreciation in the dollar despite anything else. And the last statistic that I'm looking at right now is bank failures, the strength of banks around the world. If banks continue to fail, or if banks in Europe have write-downs, that's incredibly bearish for the European currency, and we could see massive losses very quickly in that currency based on bank failure. So I'm looking at oil, I'm looking at the US stock market, I'm looking at job losses or job gains eventually in the United States, and I'm looking at the banking and financial sector in the United States as well.